Good morning, everyone. It's good to see that so many of you can manage to wake up this morning to come back to listen to Stephane today, this morning. It's a bit similar to what we did yesterday in conversation, to have a quick snapshot of a specific subject. And thank you so much, Stephane, for joining us this morning. Two Stephane, two French guys. It was not made by design, by the way. We'll start it probably to try to learn a bit more about you, Stephane, where you come from and how you end up at being the CEO of Euronext. You were a banker for many years and then moved to the exchange world. Can you explain a bit your parcours?
Well, thank you very much, first of all, to all of you. I mean, to the ones who were capable to combine enjoying Brussels by night yesterday and being in this room today, this morning. Thank you for asking those personal questions. I mean, talking about me is my favorite topic, like for all of you, I guess. No, I joined Euronext in 2015, November 2015, at the moment where the company had no CEO, because the CEO had resigned a few months after the IPO. Because the definition of Euronext asset at that time was basically the stock exchange, cash equity trading museums of Paris, Amsterdam, Brussels, and Lisbon that ICE didn't want to keep after the acquisition of NYSE Euronext. So in 2013-14, ICE took over the combined group NYSE Euronext. They cherry-picked the assets they wanted to keep, the New York Stock Exchange, the life derivative markets that had been acquired historically by Euronext, and other good growing assets. And what they considered at that time as being the deadwood was dumped from the truck on the side, and they did a fire IPO in June 14, and the CEO resigned, and no one believed that the company existed. So that was at that time that I was recruited by the board, probably because nobody else wanted a job. And no, I'm serious, because I was running Santander Global Banking and Markets for Continental Europe, which by Santander standards means Europe minus Iberia minus the UK, and basically, I was a lending banker, financing banker to a large extent. So with a strong view as to counterparty risk, cost of capital, cost of liquidity, which in my view seems to evaporate a little bit too much in the discussion about bonds. We'll come back to that. But when I look at the competitive and dynamic around bonds listing, it seems like everyone behaves as if cost of capital, cost of liquidity, cost of risk does not exist, and that you can just produce a form, raise money, and hope that it will be paid back. So the debate on transparency, in my view, should be looked at in a very, very serious way, because when you come from banking, lending, you have much higher standards in terms of counterparty risk, documentation, cost of capital pricing, cost of liquidity pricing. And that's why I'm concerned about the dynamic on the arbitrage between transparency and reliability of documentation. But that's another topic. No, so I took the job because I had never been a CEO of anything, and even less of a listed company, and we tried to reset, reboot the company. I was given this opportunity at my personal life level to transform something that was weak, vulnerable, threatened by the merger between Deutsche Börse, the attempted merger between Deutsche Börse and LSE, and it was a very, very weak company. We could not recruit people. We could not have any bank not a single bank wanted to work for us, because they thought that we were a desperate case. And my CFO resigned in March 16, just after he got his bonus, 6 weeks before the first investor day of the company. So I had no CEO. I was new in the job. Deutsche Börse and LSE were merging. I mean, I had a lot of compassionate calls from guys who were telling me, that's okay, sell the company and run away. And what we have done is exactly the opposite. We took the company that at that time had 430 million top line, 1.4 billion market cap, and an EBITDA margin of 30%, 35%. And in 8 years, 10 years now, we took it to a market cap from 1.4 billion to 9.5 billion, a top line from 430 million to 1.5 billion, an EBITDA margin from 30-ish% to 60-ish%. So that's a lot of hard work. A lot, I keep repeating in every meetings with my teams, resting or remaining free, one has to choose, and that's Thucydide, this comment in the War of Peloponnesus, and that's absolutely that. So we turned the company performance around completely because we decided that we are a supplier to finance. We are not a finance company. I tell my teams we get into the building of our clients through the supplier door, not to the main gate. We are helping them making money, and we started our process of buying other market infrastructures. We pushed the EBITDA of the assets we bought massively for a very simple reason. Historically, legacy market infrastructures are companies where people work like in the Chamber of Commerce and are paid like investment bankers. So in order to push the EBITDA, you just make sure that they work a little bit harder than in Chamber of Commerce, and you pay them less than investment bankers, and that's how you double the EBITDA. Because we are market infrastructure. We are suppliers of finance. We are not in the finance industry. And when you run the company as an industrial group, we can fundamentally leverage the operating performance. Then we embark into very ambitious technology programs, the development of a new single technology platform. So we move to the next level in terms of building a single liquidity pool, a single order book, a single technology platform, which is the fundamental backbone for extracting synergies every time you plug in the system another exchange. And that has allowed us to become a legitimate consolidator of the Irish Stock Exchange, Oslo Børs VPS, Borsa Italiana. I must remind you that when in 2016, among the buzzwords of this industry loves buzzwords. They love SPACs, blockchain, bitcoins. AI is a bit different, but at that time it was the buzz of the industry in 2016 was Deutsche Börse did not manage to merge with London Stock Exchange, hence consolidation of market infrastructure in Europe is not possible.
Yes.
Maybe, maybe not. And that's what we have proven. So we have built this consolidation. We have built this culture of operating performance, of delivering on time, on budget, heavy lifting IT projects, because we are all in an industry where IT projects are submitted to the 3 times too low. And the 3 times too low is every single IT project, number 1, costs twice more than anticipated. Number 2, delivers twice less functionalities than anticipated. And number 3, takes twice longer than anticipated. So we've proved that rule wrong by being super disciplined, super militarized in the delivery of heavy lifting IT projects. And that has allowed us to create a situation where the company, for example, to give hard facts or hard numbers beyond the punchlines, we said when we closed the acquisition of Borsa Italiana that we would be delivering 60 million of run rate EBITDA synergies by the end of 24, 3 years later. By the end of 23, we had already delivered 75 million of run rate synergies. And by the end of 24, the initial target date, we will have delivered probably, for sure, 115 million, probably 120 million. So we will deliver twice more synergies than anticipated. We have migrated the the core data center of Euronext from Basildon in the UK to Bergamo in 14 months from the date of announcement to the go live. And that was just like any migration, a combination of working hard with supervisors to make sure that they stamp everything, working very hard with clients to make sure that until the last client is ready, no one is ready, therefore working on all the food chain in the industry, and working hard in delivering on time or on ONUS, which is the technology platform. So that's Euronext. But in addition to that, we build a very diversified company. The paradox is that the rest of the world looks at us as an equity trading and equity listing business, which we are very proud of being. We have not deserted this business. Some of our peers in Europe have decided implicitly or sometimes almost explicitly that cash equity trading and equity listing is a vintage legacy business and that they should walk away or run away from that business. We do not believe so. We believe that exchanges have a critical role to play to empower capital markets to finance the real economy. But we diversify the group. I mean, today, equity listing and equity trading represent 18% of the top line of the group, even if it represents 80% of the questions, the comments, the perceptions, etc. The rest of the group has diversified significantly away from that. We have diversified in other asset classes, and maybe we'll come back to this point because we have diversified massively in fixed income, in particular with the acquisition of MTS, which has given us the access to one segment of fixed income, which is the govies world, which is not a bad segment to be in Europe those days. We have diversified in power trading with the acquisition of Nord Pool, and we now operate the benchmark, the peer, the nose-to-nose competitor to Apex, the Deutsche Börse commodities business. We have grown significantly our wheat commodities business because, surprise, surprise, among the top 5 producers of wheat in the world, you have Russia, Ukraine, and France. So clearly, risk management is an issue in this segment. And we are now a visible player in Forex trading. So, but beyond trading, we have massively diversified in post-trade and through the acquisitions of various CSDs, through the acquisition of CC&G, and we have turned the sort of clearinghouse of Italy into the European clearinghouse. And today, all the European cash trading on Euronext markets is cleared on Euronext Clearing, formerly known as CC&G. And in a few weeks' time, the derivatives products traded on Euronext will be cleared on Euronext Clearing too. So this diversification is profound. What I want to highlight here is what we have done on fixed income, because we started our fixed income journey with an attempt to become relevant for corporate bonds trading, with an attempt to become relevant with retail participation in corporate bonds trading, which was relatively weak. There were 2 game changers in our relationship with fixed income. The first one was the acquisition of the Irish Stock Exchange in 2018, where we became one of the key players and now the leading player in fixed income listing, in bonds listing with Dublin. And today we have 58,000 bonds listed on Euronext markets. We are, I think, the leader by the world leader in terms of number of bonds listed on Euronext markets. Most of them, I would say approximately 80%, are listed in Dublin. And this Dublin platform has achieved an amazing migration to position itself as the most relevant platform for ESG bond listing. We can come back to this world where our obsession now is how to accelerate 2 things: how to make transparency more efficient, how to make the process more technology savvy and more fast and quick without compromising reliability. You mentioned that I was a former banker, but before, when I was young and slim, I started my career as a lawyer with Freshfields, as an M&A and financing lawyer. I've been in litigation on bonds. I mean, everyone who is born since who is starting his career less than 20 years ago doesn't remember what interest rates were. I mean, they discovered that a few months ago. But there was a time when people were borrowing money, were not able to repay, where despite restructuring, things were going wrong, and where people were going to court to get back some of their money or to protect their job because they say, my client doesn't pay, at least I need to sue him so I can make sure that I'm doing what is needed in accordance to the protection of my shareholders' interest. Litigation happens in lending, litigation happens in bond, or will happen. So I'm just telling you guys, and read my lips, all the ones who believe that they can't be very comfortable with issuing or trading on the bonds, which is a piece of paper that they got for free. If you believe, just like in agriculture, that when milk is cheaper than water, this is a balanced equilibrium, prepare for litigation. I'm saying that no matter how simplified or friendly or technology funny and API-driven is a bond prospectus, it remains a very complicated commitment to repay capital and to pay interest, which is priced for the cost of capital, the cost of liquidity, and the cost of the risk. And the other thing we're trying to do is to embark the retail participation in this industry. But I believe we can have a role because retail participation is very weird. We have countries with a huge retail participation in govies. In Italy, we have countries with retail participation on derivatives in the Netherlands. But in general, you find retail participation more stabilized in equities. We try to use the culture and the tools that we have developed for equity retail participation and try to make them available for participants in bonds trading. And the other side of what we are trying to do is to take the MTS business to the next level. Our fixed income business is listing with Dublin and ESG, and we can talk about that if you want. ESG bonds, we are leaders, retail participation, and also on the trading side, to grow the govies business of MTS above and beyond its core legacy, historical, very efficient Italian liquidity govies business. And I'm very, very proud of what we have achieved. It took us 1.5 years to get appointed by the European Commission as the electronic platform for the trading of the Next Generation EU program, as you know, 750 billion EU govies. It was very long because those guys were so in a rush of issuing, so in the hands of banks that wanted to stuff them again with the cozy primary dealers club. So let's keep things opaque so we can keep the monopoly of the information and bullshit the clients. The cozy primary dealers things, which is very, very great and very powerful in crisis times because at least you have friends to help you in rough times. Trying to convince them that, hey, maybe there is a benefit in more transparency, in more real-time information, in non-intermediated information about flows. It took us 1.5 years, and it worked. And today, the third largest asset class that we trade on MTS, after Italian govies and Spanish govies, is Next Generation EU govies. So we are very enthusiastic. That was the first question.
Exactly, because we are already over time by 4 minutes. So I think we'll have to invite you over again for next year to go from number 2, etc. Maybe in like less than a minute. I know CMU is a very big topic for you and for Europe. Very quickly, if you have, some comment on that, and then we finish on this one.
No, I'll take more than 1 minute, and I apologize for the following ones, but that next time you should not invite me at all. See if you want, if you want to manage your time. We are about to turned to a completely different environment. CMU has been a very boring topic for the past 8 years, just because it was invented by Jonathan Hill, the UK, when they were the largest financial center of the European Union. And now that they have become the largest financial center of the United Kingdom, there is no political ownership of the CMU. That's why we had, over the past 8 years, a sort of delivery of very fragmented, sometimes weird, like unbundling of research regulations, or unclear regime on systematic internalizers. We had very fragmented, unclear rules. The world is changing completely. I can tell you that with the next Parliament and the next Commission, after the 9th of June for the Parliament, after the summer for the new Commission, we are going to face a fundamental acceleration of the CMU in at least 2 directions. One is immediate, impactful measures for defragmentation of the markets, and we have no time to cover all of them, but I have produced an op-ed that will be published in a few days everywhere in Europe that will cover what, in my view, are the priorities. And in parallel, and that's very, very important, and I can tell you that I feel it at last happening, governments will start taking domestic measures to redirect savings from govies financing to equity. Everyone realizes that the paradox where we have the highest saving rate of households in the planet, with 13.3% of savings in GDP, distracted massively to govies financing or to the US, is going to end. So we will have, sooner rather than later, the end of this tax distortion in favor of govies versus equity, and we will have, sooner than later, incentives for driving European savings and institutional money towards equity. The name of the game for the next 5 years is, and I dare to say it in a fixed income focused transaction, is MEGA, make European equity great again.
Okay, on that note, thank you very much, Stephane. It was great to get some insight from you, and hopefully we'll have a good day today for the last day of the conference. Thank you very much.
Thank you.
Great to see you.